sovereign wealth funds quietly pull the strings of global finance, shaping policies you never see coming. And number one is something almost nobody guesses today. Imagine a fund so massive that its investment choices dictate climate strategies worldwide. Norway's government pension fund Global, often called the Oil Fund, now holds over $1.3 trillion in assets, making it the world's largest sovereign wealth fund. By applying strict environmental, social, and governance criteria, the fund can block or pressure companies into greener practices. Recent decisions to divest from coal miners and to limit exposure to fossil fuel producers have forced multinational corporations to rethink their carbon footprints, not just in Norway but across every market where the fund invests. Moreover, the fund's annual stewardship reports are studied by regulators, giving it a soft power role in shaping climate policy dialogues at the UN and in the European Union. While the fund's primary goal remains long-term return for future generations, its ESG stance demonstrates how sovereign wealth can leverage financial clout to steer global policy without ever passing a law.
Consider how a single fund fuels a nation's entire economic transformation agenda. Saudi Arabia's Public Investment Fund, now exceeding $600 billion, is the financial engine behind Vision 2030, a roadmap to diversify the kingdom away from oil. The fund invests heavily in entertainment, tourism, and technology ventures, from building futuristic megacities to acquiring stakes in global tech firms. By channeling capital into sectors previously untapped, it nudges regulatory reforms, eases foreign investment restrictions, and reshapes labor laws to accommodate new industries. These moves ripple outward, influencing regional market expectations and prompting multinational corporations to recalibrate their Middle East strategies. Though its primary aim is domestic growth, the fund's global partnerships and high-profile deals signal a broader ambition to rewrite the kingdom's economic narrative on the world stage.
Surprisingly, ADIA's quiet acquisitions reshape skylines across continents. The Abu Dhabi Investment Authority, managing roughly $800 billion, has a long-standing appetite for prime real estate, from iconic skyscrapers in New York to luxury resorts in the Caribbean. By purchasing landmark properties, ADIA not only secures steady rental income, but also subtly influences local zoning decisions and urban development policies. Its low-profile strategy often means deals are announced months after completion, allowing market participants to adapt without panic. Moreover, the fund's preference for sustainable building standards has nudged developers toward greener construction practices, echoing Abu Dhabi's broader environmental goals. While the returns support the Emirates' long-term fiscal health, the ripple effect on city planning and real estate market dynamics illustrates how sovereign wealth can steer physical landscapes worldwide.
Few people know that China's sovereign fund quietly bankrolls infrastructure that shifts trade routes. The State Administration of Foreign Exchange's investment arm, often referred to as SAF, allocates billions to Belt Road projects, from ports in East Africa to rail lines across Central Asia. By financing these massive undertakings, the fund lowers borrowing costs for partner nations, making Chinese-built corridors more attractive than alternatives. The resulting economic interdependence subtly aligns participating countries with Beijing's trade policies and standards, influencing everything from customs procedures to digital regulations. In return, the fund gains long-term revenue streams through tolls, fees, and equity stakes. This strategic financing demonstrates a blend of financial muscle and geopolitical intent, allowing China to extend its influence without overt diplomatic pressure.
Hidden in the background of sovereign bonds lies GIC's strategic push into emerging market debt. Singapore's sovereign wealth arm, managing around $750 billion, has steadily increased exposure to high-yield sovereign bonds from Southeast Asia, Africa, and Latin America. By providing deep liquidity, GIC helps lower borrowing costs for these governments, enabling infrastructure projects and social programs that might otherwise stall. In exchange, the fund secures higher returns than traditional developed market assets, while also gaining a seat at policymaking tables where debt sustainability is discussed. This financial relationship can nudge emerging economies toward fiscal reforms favored by international lenders, subtly aligning their economic policies with global standards. GIC's disciplined risk management and long-term horizon mean its investments often outlast political cycles, embedding Singapore's influence in the fiscal health of dozens of nations.
Behind the scenes, the future fund's voting power sways corporate governance debates in Australia. Established with about $200 billion in assets, the sovereign fund holds sizable stakes in major Australian corporations, from mining giants to banking institutions. Through its proxy voting decisions, the fund can champion or block executive compensation packages, climate disclosures, and board diversity initiatives. While the fund's charter emphasizes maximizing returns for future retirees, its shareholders' voice often aligns with broader public expectations, prompting companies to adopt more socially responsible practices. Politicians and regulators monitor the fund's positions, recognizing its ability to set market precedents. Consequently, the future fund serves as both an investor and an informal policy influencer, shaping corporate behavior that reverberates through the national economy.
In 2026, a wave of green sovereign bonds, backed by multiple funds, is steering capital toward renewable projects. Nations such as Norway, Norway's fund, Saudi Arabia, and Singapore have issued bonds explicitly tied to clean energy initiatives, attracting investors seeking both financial return and environmental impact. The proceeds are earmarked for wind farms, solar arrays, and carbon capture infrastructure, with transparent reporting mechanisms that verify the green use of funds. This coordinated push not only expands the market for sustainable finance, but also pressures traditional energy sectors to accelerate decarbonization to remain competitive. As sovereign investors collectively prioritize climate-aligned assets, the ripple effect influences global capital allocation, nudging private investors and corporations toward greener portfolios.
According to analysts, Kuwait's fund acts as a buffer, influencing global oil price expectations through its reserve strategies. The Future Generations Fund, holding roughly $600 billion, deliberately adjusts its sovereign wealth holdings in oil equities and futures to smooth out price volatility that could affect the national budget. By buying when prices dip and selling during spikes, the fund signals confidence in market stability, which can temper speculative trading and reduce extreme price swings. Moreover, the fund's public disclosures of its oil-related positions are watched by traders worldwide, making its actions a quasi-policy tool. This subtle market-shaping role showcases how a sovereign wealth fund can extend its influence beyond domestic fiscal planning to the broader dynamics of a commodity that fuels the global economy.
A striking example is how Russia's fund finances defense, indirectly affecting geopolitical risk assessments. The National Wealth Fund, part of Russia's pension system, allocates billions annually to defense contracts, technology upgrades, and strategic stockpiles. By channeling state-derived capital into the defense sector, the fund helps sustain a robust military-industrial base without relying solely on annual budget appropriations. International investors monitor these allocations, adjusting risk premiums for Russian assets and influencing sovereign bond yields. The fund's expenditures also send signals to neighboring states about Russia's long-term military commitments, shaping diplomatic negotiations and regional security calculations. While the primary purpose remains to support future pension liabilities, its defense-focused spending illustrates a dual role in both fiscal security and geopolitical strategy.
Ultimately, coordinated meetings of sovereign wealth funds at the IMF create informal policy corridors that shape global financial rules. Twice a year, representatives from the world's largest funds gather in IMF-sponsored forums to discuss investment trends, regulatory developments, and macroeconomic outlooks. Though not a formal decision-making body, the consensus reached often informs IMF research papers and policy recommendations, subtly guiding the international monetary system. Topics like capital flow regulations, taxation of cross-border investments, and climate-related financial disclosures emerge from these dialogues, later echoing in official IMF guidance and member state reforms. The collective voice of these deep-pocketed investors thus amplifies their ability to influence standards that affect banks, corporations, and governments worldwide, extending their reach far beyond traditional asset management.
We've uncovered 10 ways sovereign wealth funds operate behind the scenes, from climate-driven divestments to covert infrastructure financing, showing just how powerful these state-run investors can be. If you enjoyed this deep dive, hit the like button and subscribe so you don't miss the next mind-blowing list that drops every week. Which of the 10 tactics surprised you most? Let us know in the comments below. I'm eager to read your thoughts.